Now let's look at number 7. So number 7, we have Kyler Media Corporation, and they have the following income statement and balance sheet for 2015. And we're going to be dealing with the investing and financing cash flows. So they gave us our balance sheet here. They want us to compute the acquisition of plant assets for Kyler Media Corporation during 2015, and it says they sold no plant assets during the year. Okay, so that's an important piece that we need to know there. So the best way to do this is to really go over here and look at our balance sheet, okay? So we got our balance sheet right here, and look at those long-term assets. So I'm going to come over here and I'm going to put on here what our balance is in our assets this year. So we started out at the beginning of the year 2015 with this much. So that's last year's plant assets, $83,750. Okay, that's what we started with. And then we ended up with, on December 31st, 2015, $100,350. So we need to know what took place during the year that made this change. So they said that they sold no plant assets during the year. So selling would have reduced this. So I'm going to go ahead and put 0 here and put, we call those disposals when we sell them. So we have 0 disposals. So that must mean that the full difference in our assets of $16,600 must have been due to acquisitions. Okay, so it's due to acquisitions. All right, so it's $16,600. Then they said they want us to compute the payment of a long-term note payable during the year. Okay, so let's look at note payable. So now we're going to come over here and look at our liabilities. So that note payable we started with at the end of last year. We started with $15,000, and at the end of this year, we ended up with $9,000. Okay, so let's see what they told us though. It says during the year the business issued a $5,300 note payable. So that must mean that we had an issuance. So when we issue new debt, remember it increases with a credit, and I put these on the wrong side. So ignore that. All right, so our liabilities have credit balances. So we started with $15,000, ended with $9,000, and when we had an issuance, that increases it by $5,300. Well, the difference between our ending balance and the beginning balance is a reduction of $6,000. So if we know we had an increase of $5,300, we need to know, well, how did we get from the sum of those $20,300 to $9,000? Well, we must have made some payments, right? So that's what we're looking for. We're looking for the payments. And this is, if you're seeing this is the reason why doing a T account is the easiest way to calculate this. So then the difference between the $20,000 and the $9,000, so the difference between that, the beginning balance and the issuance, and the ending balance are our payments. So that's how much we must have paid on our debt to get it down to $9,000. Okay. Now this information is what we would use to do our investing section of our statement of cash flows in our financing section. Okay. So if you have any questions on that, please post your questions in the discussion board in the module.